Yo, what is up guys? Welcome to my channel. I'm RayTrade and today we are going to talk a little bit more about liquidity. Let's get started. So before we get started, it's important to know what is liquidity. So liquidity is to reduce the buyers and sellers in the market, which will cause the brokers to make more money. And second of all, it is for the big institutions to get their orders full in the market. So there is only two types of liquidity in the market. It is buy stop liquidity and sell stop liquidity. So buy stop liquidity, we should look for the previous monthly high, previous weekly high, previous daily high, all swing lows, equal highs, swing market shifts and stop hunts. With sell stop liquidity, we should look for previous monthly lows, previous weekly lows, previous daily lows, all swing highs, equal lows, swing market shifts and stop hunts. What is sell stop liquidity? So sell stop liquidity is when there is sell stops being placed below the support that the retail traders are spotting in the markets right there, and they put their sell stops right below the support right there, and then they are waiting for a breakout to the downside, and they are hoping that the market will be continuing to the downside. So what does liquidity do? The liquidity takes out this sell limits or sell stops actually, and it reverses to the opposite side, which is going to be called a liquidity sweep. So the market, what the market did actually there is it took out both the sellers and the buyers in the market. It took out the buyers that bought from this support key level right there, and the sell limits, the sell stops that is being placed right there with the traders that are trading the breakout strategy. So what does liquidity do? The market reverses to the opposite direction. So we as liquidity traders, we can enter based off this liquidity sweep right here, and we can put our stop losses right below the lows and target the highs. So buy stop liquidity is exactly the opposite. We have our consolidation or our support that is being hit right there, and the market goes out and it goes for a liquidity sweep, and it reverses to the opposite direction. So right there is going to be tons of buy stops right there, and there's going to be tons of stop losses of the sellers right there that is selling the market right there and waiting for the market to continue to the downside. So what the market did, it went for a liquidity sweep and took out both the buyers and sellers in the market. We can also enter based off this liquidity sweep right there, and we can put our sell orders right there, and we can put our stop losses right above the highs, and our take profit to the lows. So let's jump into the market and give you guys some examples. Second of all, we need to identify our daily biases on a bigger time frame. So as we can see, the market moves in a clear direction, which is going to be our daily bias. So market moves in an uptrend direction, which means we are going to mainly look for buys in the market. So jumping into the smaller time frames, we first of all need to identify our sessions which we are going to be trading. I'm using this indicator by Lux Algo. It's called Sessions, right over here by Lux Algo. So you can use this indicator to help you identify the sessions which we are going to be trading in. We have our London session right over here. We have our highs that happened right around here, and we have our lows that is right around here. So what does the market maker do? The market maker goes for a liquidity sweep in taking out tons of stop losses of the retail traders. So retail traders is going to be having their stop losses right around here, and the market maker takes out their stop losses and it reverses to the opposite side. So when trading liquidity is we need to have a liquidity sweep. It's going to be either up or down, and then we wait for a pullback into the market, giving us a break of structure, which is going to be our confirmation that the market is moving the opposite direction. Right around here we have a break of structure to the downside. We know the market is going to move to the downside, so we take our short position and we are putting our stop losses right above the highs, and we are taking our take profit right to the London lows. So this trade is going to be giving us a total of 2R, which is not going to be our best trade, but it is at least something. So right around here we have a liquidity sweep of the London lows in the London session. So we know this is a valid trade. So right around here we have a liquidity sweep, and we trade based off the pullback, and the market gives us a break of structure to the upside right around here. So we are going to take our trade based off the break of structure, and we are going to target the highs of the London. So right around here we can see the trade gave us a total of 3.3R, which is going to be an amazing trade. Let's jump into some more examples. So right here we have another perfect example. We first of all mark out our London and New York lows right around here, and we mark out our London highs. Right here we can see a clear liquidity sweep that happened right around here. This trade is going to be giving us a better risk to reward. When taking this trade, we are going to put our stop losses right below the lows, and we are going to take profit to the London highs. So as we can see, this trade gave us a total of 18R, which is going to be an excellent trade. That is going to be it for today's video. If you found this video helpful, drop a comment and hit the subscribe button. See you guys in the next video.